But welcome to the April 6th edition of Market Matters. My name is Todd Jones. I'm the Chief Investment Officer for Gratus Capital. For those of you that I haven't had a chance to meet with yet, thanks for joining us today. Just a quick overview of some of the what to expect on the webcast. This will be usually between 30 and 40 minutes, depending on time or even some of the content we'll cover. If you do have a question, please lob it into the chat feature of Zoom. It should be on the drop-down bar there. I'll try to grab those off and cover those as we cover certain content along the way. And if there are any follow-up items that you would like to ask a question about, please feel free to reach out to your advisor and we'll connect and get back to you as soon as we can. So let's take a look at the agenda for today. We're going to have our founder and CEO, Hank McLarty, on as our special guest. He'll cover a few topics, which I think you'll find very interesting. Next, we'll go through the COVID-19 update, which I'm starting to call now the vaccine distribution update, but still similar content area. And then we're going to go through some of the economic update separately, and it's kind of a new way to break this down. That's going to be separate and distinct from the Q1 21 review and investment outlook. So with that, let's get started. And on the call today, we have, as I mentioned, Hank McLarty. He's our founder and CEO. And I'm just going to say, Hank, thanks for joining us today, and feel free to provide some updates to the group.
Yeah, thanks, Todd. It's great. It's great to be here with everybody. We're certainly missing seeing all of you live, but we are planning to start back with our face-to-face market updates in the fourth quarter of this year, assuming everything stays on track. So we're really excited about that. And I just wanted to give you a quick update on some of the happenings at Gratus. Obviously, we're growing. I'm sure you're seeing the announcements and so forth, but the firm is growing. And, you know, part of our vision is to be the most client-focused wealth management firm out there. And last year, we had to make a lot of changes as a result of COVID. So a lot of our interaction with clients, in fact, almost all of it turned into Zoom meetings. Last year, as a result of COVID, we created Market Matters that you're on right now. We created 2 Minutes with Todd, and frankly, many other avenues for communicating with all of you about how our investments are doing and other things going on with the firm. So I'm pleased to say that our formula worked. We actually had the best year we've ever had in terms of asset performance last year, and also in terms of growth of the firm with new clients. So 2020 was the best year we've ever had, and then the first quarter of this year is the best quarter we've ever had. So something about our formula is working, and I will tell you that we are 100% committed to continuing to improve our firm and grow from a client-focused basis. And we're also in our growth to honor this vision of focusing on our clients. We're continuing to add team members. So we are on schedule to hire 11 new team members this year, again, to ensure that our attention and our service for you gets better as we grow. I'm also pleased to announce that we're moving into a new office in October. So we are busting at the seams in our existing office, and when everybody gets back to coming to work on some kind of schedule, we need a new office space. So we're moving into our new office this October of this year, and we're super excited about it. We're going to have our team on flex schedules, so some people will be able to still work from home on some days and work in the office some days, but it's going to be a great collaborative environment for us to get together for team meetings and individual teams within the company meetings and so forth. So our goal is to make this office like no other wealth management firm out there, and we're really excited about it. And finally, I wanted to mention to you, you've probably heard a good bit about this, but I want to make sure that you know it's a priority to us, is our surveys that we're sending out. So we will be sending out surveys to new clients as they get onboarded to find out how their onboarding experience could have been better. And equally as important, we're sending out surveys every January. So we'll be talking about it a lot as we get closer to the end of this year. Those surveys are how we find out from you how we're doing and how we can improve. So we're going to keep them short and sweet and just ask a few questions, but you'll be hearing a lot more from me and the rest of the team about making sure that we see those surveys in your inbox and get them back to us and let us know what we're doing well and let us know how we can improve your experience. This is really an important part of us moving forward as a company. So with that, thank you for giving me a few minutes to give you an update, and I'll turn it back over to Todd.
Oops, sorry. I realized I was on mute there. Moving into the COVID-19 update, looking at U.S. distribution, it's really turned into something that is something very positive. As maybe just a few weeks ago, we were only at the 2 million vaccines being given per day. Now we're at 3, and this is an important inflection point in our vaccine delivery in the U.S. because it means that roughly 50% of the population could have had the vaccine, both vaccines, by the end of April this month. So that is a very important milestone to hit because 70% is the crucial number. That's the herd immunity number. And if we can get there before any of the variants become more of an issue as they are in other parts of the world, then I think our COVID worries will be not as acute in the future. And then this is just something to take a look at, given what are other countries in the world doing, and what should we be concerned with, or what should we celebrate? Gibraltar administering 90% of their population isn't really a big achievement necessarily, because their population, having been to Gibraltar, I think they only have probably like a few hundred or a few thousand people that live there. So, well done. But more importantly, places like Israel, they're at that 50 or 60% mark. Is really a milestone to reach for, because now vaccine or COVID rates in Israel now close to 0 after being pretty high a few weeks ago. U.S. still has a little bit of a ways to go, but the good news is that a lot of other countries are now starting to catch up. The one problem, as you'll see here in a minute, is that we still have very populated developing countries like India having a real issue with vaccine administration. And I think that's, you can see that here. While we do have good administration in the US, globally, we're still ticking up in new cases, which is not a good situation. And particularly in these areas, like I said, very populous areas, a billion and a half people live in India. Brazil, I think there's close to 200 million people there. Iran, not a very populous country, but it's still important to understand that the vaccine or the infection rates in these areas are rising now again, which is a bit problematic. And then of course, Germany and France having increases in their rates is problematic, because that most likely relates to the variants that are spinning off or spawning. And that's why, getting everybody vaccinated as quickly as possible, I know has been the Biden administration's one of the top priorities, because if the longer you let this linger, the harder it is to address, because the variant COVID-19 virus will adapt to new new drug therapies. So we have to get this under control. So moving to the economic update, I think, as you've probably noticed, within some of the publications or reports that have come out, the U.S. economy is just on fire right now. Now, there's 2 reasons for that. One is because what they call the base rate, or the rate we were at a year ago, was very low, right? It was probably the trough of economic activity. So from year to year, it looks really good. But the good news is that there are also, in absolute terms, there are changes that are very positive. One of which I think that goes underestimated is the housing market, just on fire right now, up 11% on average in the across most of these composite indexes. 10, the largest 10 cities in the US, largest 20 in the national index. And this is really, I think, really important, because it definitely stimulates what the Fed is trying to do, which is creating a wealth effect for both middle and higher income households. Of course, we have a distribution problem of incomes that does not accrue to the lower levels of the educational scale. But this is a very positive dynamic for sure, that obviously we can't sustain these types of price gains forever. But what's creating this, it's really actually, I think, a combination of very low supply. I think we have the fewest number of single family homes on the market right now ever, since records began being kept at like one month of supply, or in other words, 600,000 to 700,000 homes on the market nationally, not in Georgia or the East Coast, but nationally. That's not a lot of homes for a population of 350,000 or 350 million people. But also the underlying economic data looks very positive too. And these were data reports that just came out in the last 2 days. So I think it's very timely to touch on these. What you're looking at here is the manufacturing sector. So this is what they call the ISM Manufacturing Index. Any level above 50 here means that we're in an expansionary period for manufacturing. Anything below 50 means we're contracting. And two things come to mind here when I look at this chart. One is this is the highest level of rate of change in the manufacturing index since the early 80s. And we've not been here outside of very robust growth periods in our history. But the second thing is that over the last 12 months, it's just been a gradual rise in manufacturing activity, which I think just bodes well for continuing momentum into the middle of the year, more or less. So it's creating a positive feedback loop on the manufacturing side. The same could be said for this ISM Services Index. This is the sister index to the manufacturing index because the US economy is made up of both the manufacturing sector and the services sector. And what you see here is the highest reading, I think on record actually, in the services index. So, that's very positive, something very important to look forward to. And we'll touch on the inflation question, because I know that's been something that's been on the minds of some clients to say, well, isn't all this growth and gains in the economy going to create some inflation? And I think, well, you'll when we get to that section, we'll certainly touch on it. But a very positive backdrop, I guess, is my point. So now let's take a look at what happened in Q1 of 21, and then give our outlook for 21 and beyond. And here are just some general notes. I like to try to make these as simple as possible. We can certainly review any of these more in depth on a one-on-one basis, but just to give you an idea of some activity that's occurred so far this year, we did a very well-timed rebalance of our growth-oriented positions, the U.S. large-cap growth positions, in late January. And actually, that was within about 2 weeks of those positions peaking. And what did we do with that capital? We added to a cash equivalent position, which we'll talk about in just a second, and also to our liquid alternatives positions. And that's been very additive in a number of ways, because number one, US large cap growth has struggled basically since mid-February as interest rates have risen, but also it's giving us an opportunity to add to maybe more undervalued positions on the value side, or in absolute return positions on the alternative side. We did also want to point out a major shift, not a major, but a pretty significant shift in our asset allocation recommendations for portfolios. If we're managing an account for you right now, we've already made these adjustments, so you don't have to ask if they happened or not, because they would have happened already. But back in mid-February, we decided to underweight fixed income positions and increase our liquid alternative positions for two reasons. Number one is that interest rates were generally rising, which tends to be not a good situation for fixed income, as you'll see in just a moment. And number two, what we replaced it with were the income generating alternatives, or growth alternatives. And those have actually posted positive returns this year. Whereas if we would have left those positions in fixed income, they would have been negative by about 3%. So just wanted to point that out. On the equity side, we'll touch on it in just a moment, but there was a pretty massive rotation into large cap value and small cap earlier this year, at the expense of large cap US growth positions. Again, these are just observations. We'll touch on them a little bit more here in a second. I would point out too that portfolio turnover is increasing a little bit across most of our strategies, and that is relating to rebalancing activity or tactical shifts. And that's creating some capital gains. We certainly recognize that, but we feel like these would be we would be missing if we didn't, or remiss if we did not undertake these activities just so that we can create capital gains to preserve the risk profile in the portfolio. And we think actually probably later in this year, there might be some good opportunities to do some tax loss harvesting if volatility kicks up really massively. And then, continue to want to point out that actively managed equity strategies are right now doing very well, and they present a pretty compelling risk and return proposition. Fixed income, the only thing I wanted to mention here was active positioning in fixed income has helped with managing the interest rate issues that we're seeing within the markets. Because what happens is interest rates rise, bond prices fall, and that led to, as you'll see in a moment, roughly a 3% decline in the aggregate bond index. Our positions didn't go down nearly as much as that, although still negative, not nearly as much. So we're pretty happy about that. But we are keeping our fixed income strategy in a higher quality and shorter duration posture so we can preserve capital and really be ready to take advantage of opportunities when they come up. And then on the alternative side, we are changing out some positions, or we have so far this year, as some strategies become more correlated with stock market or bond market, in favor of those that can really benefit from volatility, because that's really, I think, been additive in Q4, Q3, and Q4 of last year, and into this period. While volatility has subsided a little bit, I don't really see a reason for that to go down to historical levels anytime soon, given all the changes that are occurring right now in the economy. Income generation, this is becoming a more important source for income in portfolios than the fixed income positions are now, because just the forward-looking return for alt fixed income positions are much higher than traditional bonds. And then we are seeking, it's just important to note, we are seeking true diversifiers for the volatile periods that might lie ahead. So that would include some things like digital assets that are on our research agenda that we've been kicking around for the better part of the last 6 months. We've yet to make any allocations to that, of course, but that is rising to the top of the research agenda. And then here are our investment rankings. I just think it's important to know kind of what we were saying in Q4 at the last quarterly market update then, and to where we are now. And so around that time, we were saying, hey, we should start to maybe look to underweight bonds, which, as I just mentioned, we did that. But also maybe looking for ways to take advantage of some of the growth that's occurring, migrating up a mid-cap as an asset class to a more neutral weighting, and that continues to be an ongoing search that we have out for that particular asset category. But still fairly neutral on stocks at the index level. Active is definitely where to go. And then from a alternative standpoint, we still see a lot of value in what they call real assets, these liquid alternatives, and then private markets, as you know. And I did just want to make sure we covered one foundational concept, because it can be lost when one asset class does really well relative to everything else. And this is just, I think, one of the case studies for a diversification and what that can do for you. And again, we're not undertaking the effort to diversify for any other purpose other than to reduce risk and provide for a smoother ride from here to wherever your plan ends. And what you see here is the black line is the diversified portfolio. It includes a composition of stocks, bonds, but also some alternatives, and I believe a currency position in there. As opposed to the S&P 500 index. And you can see in this red box here is the outputs, like what actually happened starting in January of '99 to December of 2020. And you can see it was almost an identical, a little better return for a diversified portfolio, but the risk profile was much better because if you take a less of a hit on the drawdown, then the mathematics work in your favor to getting back to break even. That's exactly why I think being diversified and not just in US stocks or in US bonds can have some value over time. And these statistics certainly bear that out. So let's move forward to what happened with stocks in the first quarter. And what you see here are 4 different indexes, the ones we review pretty regularly. Small cap index, Russell 2000 in green, up 13. S&P 500 actually punching better than we thought it would at plus 6.5. International markets trailed off towards the end of the quarter at up around 4 for the quarter. And emerging markets, despite having a really positive move up into February, really got caught up in the interest rate sell-off and ended up the quarter only up 3%. So, I would say just the summary comments here are, significant economic activity is making its way through the economy on the back of both stimulus and reopening hopes. Small cap stocks are certainly riding this wave up, but we think, small cap is probably not the right exposure to have at this point because a lot of gains have been had in that exposure to date. We think maybe mid cap might make a little more sense. So the outlook for stocks, I think, is still fairly positive. And I think coming into this year, for an active strategy, we have mid to high single digits expectation for stocks, both US and international, a little bit higher actually for international positions in emerging markets. But I think what's interesting is to note is that we certainly are taking note of the fact that what they call lower quality growth stocks, meaning those that are not very profitable yet, that have no earnings, had just a gangbuster year in 2020, really on the back of COVID, as people were adopting technology in a much greater capacity. And we think that, moving forward, it's likely that if investors are going to favor value stocks, which tend to be more profitable than the lower quality stocks, could be due for giving up some gains that have accrued to those positions. So as you have probably seen in our individual stock portfolios, we have been sellers of some of those select growth companies that were in our dividend strategy and replacing those with more value-oriented names that are in there in like the resource space or energy space starting off the year. So we think that's the outlook here, but still, our base case is that it'll be a positive year for stocks, no question, just probably not as good as people think it might be, because the market is already expecting a substantial amount of recovery, and we think that a lot of that might be priced in already. This is, I think, a great chart to show anyone that is kind of the proofs case of why we think conditions for active management have really improved. And what you see here is a chart showing the S&P 500 equal weighted index versus the S&P 500 itself. So just to orient you, if the line is going down, that means the market cap weighted S&P 500 is outperforming. And if the line is going up, that means the equal weighted version of the S&P is outperforming. And look what happened, starting in April of last year. So there's a lot of chop until about September or October. And now it looks like the equal weighted version is, making some pretty substantial gains, which just says that the largest constituent of the S&P now are no longer the dominant driver of returns in the equity market right now, if you look underneath the surface. So I think this chart is a very useful way to say that conditions are improving for active managers, because it's not just the top 10 stocks anymore that are accounting for gains, which is, I think, a very healthy dynamic. And what's driving this growth versus value? We showed this chart back in January, or maybe even last month. And I think what you see on the screen here is, a ratio of the Russell 1000 growth to the value index going back to 2001. So again, the black line, if the black line is moving down, that means that value is outperforming. If the line is going up, that means that growth is outperforming. So growth is obviously coming off a very substantial period of outperformance in the U.S. equity market, but it did peak middle of last year and now has been going the other direction. And what really caused some of this dichotomy to start occurring was what we're seeing here in the background, which is the 10-year Treasury yield. So just for what, and this is the scale on the left-hand side for the 10-year Treasury yield, and this is the ratio on the right-hand side. So just to orient you here, for the red line, we started off in 2001 with 10-year bond yields around 5%, believe it or not, the good old days of 5%, migrating all the way down to 1.5 here in the middle of 2016, popping back up to 3 in the middle of 2018, and then getting down to, call it 50 basis points in the middle of 20. And what happened in the middle of 20 was that rates went from 80 basis points or so to where they currently sit around 1.7. And that has a very high correlation to value outperforming growth. So we think that interest rates have never been more important in the equity markets, and something we definitely want to pay a lot of attention to. And we'll go over the kind of the outlook for rates here, but I think, it's certainly a muted outlook despite maybe some of the recent activity that's occurred in rates and the distance they've traveled to. It's unlikely they get a whole lot higher from here, but we'll have to see how that evolves. And then we also have the small cap versus large cap debate, which one is going to do better over the long term. Certainly, from 2000, and again, just to orient you, if the line is moving up, that means small cap is outperforming. And if the line is going down, that means large cap is outperforming. And now we've entered a period where small cap is now rising relative to large cap. And so, but recently it's kind of tapered off here. So we'll have to see if this is really a head fake or sustainable over the long term. But I think it's no surprise that this tapering off here coincides with a more leveling out of interest rates. So in our mind, that is going to be the dominant driver of where this ratio decides to go. Currently, as you know, we have very little exposure to small cap. Moving to fixed income here, this is a very important part for a lot of folks' portfolio. We still think it is an important feature of a portfolio to have, but for different reasons, as we described on the last Market Matters. That's primarily now for capital preservation first and income generation second. But you can see here what happened in Q1. We have 4 different indexes again. We have the junk bond index here in red, doing, posting a positive return, which is actually makes sense given the amount of growth coming through the economy. These junk bonds tend to be very sensitive to changes in the growth rate. You have high quality US bonds. This is the aggregate bond index, our main index that we use to measure fixed income performance, down about almost 3.5% for the quarter, which is the largest decline outside of 2008, I believe. Then we also have emerging market bonds and the investment grade index, down about 5.5%. And as you know, we have very little exposure to emerging market bonds, and we have a fairly decent exposure to investment grade in some strategies, but those are inactive strategies. Needless to say, our fixed income strategies perform much better than -3.5. And on average, the performance was somewhere between -1 and -1.5. So we're pretty happy with that outcome, even though it was negative, because it means the recovery in those parts of the portfolio can occur much quicker. But I think our comments about migrating away from fixed income across the board towards alternatives in January was very additive, because we didn't suffer that much of a drawdown by that time, because I think the fixed income market index was only down about 1% at that time. And so looking at the outlook for fixed income, these are the big questions that we have to answer, because as a former person that has dealt very heavily with interest rates kind of drive what everyone pays for financial assets. And I think there's 2 important things to note here. The first is on the chart. These are high yield spreads. So it's not, so just to step back just a moment, what's really important for investors to understand is that it's not really the absolute rate of interest rates are. It's more about the spread between a high yield bond and a treasury. Like, that distance means that the higher the distance goes, the higher anxiety and fear there is in the markets. And what I think is really important to note is that credit spreads, or bond yields, high yield bond yields spread to treasury, widen out for various reasons, and it's usually in advance of trouble ahead. Now, this was European financial crisis 2.0, I believe. So that was showing some of that anxiety until the Fed stepped in, Mario Draghi. Back here was the first Greek financial crisis, that's where high yield bonds were rising because of the anxiety around what would happen with Greece. But in this case, we didn't really get any indication that there was trouble on the horizon from a spread perspective, because COVID was a once in a lifetime occurrence, hopefully. And what you can see, what are spreads telling us now? Well, it's telling us that there appear to be smooth waters or calm waters ahead for the foreseeable future. And these might even get a little bit lower given all the improvement that's occurring in the economy. So the bond market is not telling us there is a lot of issues on the horizon from an economic standpoint, but when you're not getting a lot of spread in your fixed income, you just have to be careful, because that can change pretty quickly. So that makes us want to be a little bit more cautious in fixed income. And then the $1 million question is all of the stimulus and added dollars to the economy by way of financial packages that are being looked at in Congress right now, is that creating any inflation that we need to be worried about? Because remember, inflation is one of those key metrics that impacts what you would pay for financial assets, right? Because if you have high inflation in an economy, you want to pay a lower price for that asset today, because tomorrow it'll be worth less, essentially. Not worthless, but worth less. And I've gotten a lot of questions from clients saying, well, hey, isn't this going to, all this monetary and fiscal stimulus going to create a lot of inflation? And what you see right here is, so CPI, Consumer Price Index, the way you measure inflation, is a backward looking index, right? Because it only reports with a lag. The way you understand where investors, or the majority of investors, think inflation is going to be, is to look at the forward expectations. And the way you do that is through what they call the five-year forward inflation. It's just basically saying, what's the difference in yield between a 5-year regular treasury bond and an inflation protected treasury bond. And the expectations have been rising for inflation, no doubt about it. But I think it's also important to put this into context, because even back here in 2010 and 2011, 2012, we had expectations for 3% that never occurred. and we're still only at roughly 2.3. So I would be very concerned right now as a bond investor, particularly if I had long bond exposure, if this was, at 3 already or something, because then it would mean we've gone from 1 to 3 in less than a year. That's not the case here, and we've still got quite a ways to go before that becomes problematic. But I would say, just from a trigger or kind of alarm bell warning, we'll be looking at somewhere between 2.5 and 3 as the kind of warning bells, just to see if we need to adjust positioning around looking at our inflation expectations. So just here, I know we're at kind of the end of our time here. Thanks for sticking with us. So here's just some key takeaways to summarize all the comments. And certainly I can definitely want to encourage you to lob any questions you might have into the chat feature. I'll leave it open here just in case there are some that are coming in. But what I wanted to just mention is that, we still continue to favor stocks over bonds, and we've been pretty consistent about that for, quite a while now. And it's precisely because we did undertake the effort of doing a forward return forecasting with the team, using a compilation of not only sell side research like BlackRock, Morgan Stanley, Goldman Sachs, and what are they saying, but also some of our own research. And we continue to recommend, slightly higher allocations to stocks for the foreseeable future. Some of you, I'm sure, are already in those positions or positionings. But that continues to be a recommendation that the investment committee has at the moment. We also continue to favor alternative strategies over bonds because their expected return is positive, where by a pretty decent margin, as opposed to the forward-looking return for the bond index is barely positive. So we think that's a great incremental shift you can make in a portfolio, particularly if you don't have any income generating alternatives in your accounts right now. That's one area to consider pretty carefully, because with alternative income investments you can find on the public side or liquid side, yields kind of on average around 4 to 4.5%, which is a lot better than the Barclays aggregate bond index, which is at 1.6. And the best part of those liquid alternatives is that they have bond-like volatility. So we're not really giving up a whole lot to be in liquid alternatives. But I do understand that there is a comfort level that some of you all might have or might not have with liquid alternatives. So we certainly want to continue that dialogue to get you to a place where you want to be. Also, incrementally, I just want to point out we are incrementally raising cash again. After a hiatus there in the middle of 2020 into the end of the year, we've now started to add back to that ultra short bond ETF as kind of a cash placeholder. And this is methodical. It's not too rigid, because coming into 2020, we had expected there to be some turbulence. We didn't know quite that it was going to be COVID-like stuff, but 2021, I would say, presents a pretty similar look to the start of 2020, which is, there's been some healing that occurred in the latter part of 2019, very similar to 2020. And so, I think we should all be expecting a more volatile market in the years ahead, in the months ahead, but also being ready to take advantage of those opportunities with an ultra short ETF is, I think, the right answer for sure. And then finally, not terribly concerned about inflation yet. And I think I just showed you why that's the case. But I think the other reason not to be terribly concerned, like what's keeping rates low right now, is that, demographics are really difficult to overwhelm with. Now, certainly if a government is committed to creating inflation, they can do it. I mean, looking at places like Zimbabwe or Argentina or, some of these other more notable inflation generating countries, or Venezuela, they're all reasons why the inflation, soared in those areas. But in the US, it's a very different story at the moment. And so we are keeping an eye on inflation expectations. And we would expect, inflation to probably rise over the short to intermediate term, through the middle of the year. But as we get through the middle of the year, we'll really have to see what kind of staying power, is in the economy, because we're still at a point where there are 4 million today. There are 4 million fewer jobs that people have now than in January of 2020. So that's a lot of folks that are out of work still, even though there's been a lot of recovery in the stock market. The jobs market has not been as robust as maybe some would have thought it would have been. And so we'll just have to keep an eye on that, because that's putting some more deflationary forces into the economy right now. let everyone know, we will be posting a kind of a schedule of upcoming events at the end of every of these Market Matters events. So our next upcoming event, we do a weekly podcast that we drop every Monday morning, somewhere between 10 and 11 o'clock. That tends to drop. And then we also have some more strategy specific market updates around our equity strategies and private markets that we certainly would encourage you to tune into for those of you that are interested. Really appreciate your time. Thank you so much for joining us today. We look forward to seeing you sometime next month. Take care.